Japan's central bank hiked its interest rates for the first time since 2007, ending its negative interest rate regime, the world's last. Now, what would that mean for the yen now? For more, we're joined by Professor Hur Joon-young this morning. Good morning.
Good morning.
So, Japan's central bank finally ended its negative interest rate policy. Now, what does it mean by negative interest rate? How does that work?
Like individual making deposit at commercial bank, the commercial bank make deposit at the central bank in the name of reserve. And the negative interest rate policy means like when the commercial bank make too much reserve at the central bank instead of paying interest rate on it, they charge fees on it. So that's so-called the negative interest rate.
I see. Well, it's a huge historic move for the Japan's central bank to do that. Now, what was the reason behind keeping the interest rate policy for such a long time then?
So like people usually says like there's like 30-year, like lost 30-year in Japan. So basically early 1990s, the Japanese economy collapses with the collapse of the bubble economy in the 80s. And they started to adopt a zero interest rate. So, zero interest rate policy started from 1990s. So it was like about 30 years ago. And then they maintained this policy over the global financial crisis period of 2008 and 9. And then in 2013, they started the so-called the negative interest rate policy. Often called the a part of the Abenomics. And the reason behind this is basically to escape chronic deflation in Japan.
Professor Hur, then can we say Japan's economy is in a better place now? Is that why the central bank pushed ahead with the hike?
I like to highlight that this shift in monetary policy in Japan is characterized by reducing the side effect of prolonged monetary easing, rather than its fundamental purpose of transitioning from accommodative to contractionary monetary policy to curb overheating in the economy and inflation. For example, the IMF project a gradual decline in Japan's economic growth rate from 1.9% last year to 0.9% this year and 0.8%. So Japanese economy still, in terms of economic growth, pretty weak. And also, inflation-wise, people expect that at the end of this year, the inflation will go down to 2%, maybe 1.8% is expected. So which means, in terms of inflation, still Japan is not escaping from the deflation era entirely. So I would like to emphasize that the Japanese Bank of Japan, the recent movement is, to reduce the side effect of the financial market driven from the negative interest rate policy, also yield curve control kind of policy.
So Japanese economy is still not in the best place yet. We've been hearing a lot of this carry trade. Professor Hur, what is carry trade and how does the Bank of Korea's rate hike affect it?
So carry trade is a speculative strategy in the financial market where investors borrow money in a currency with low interest rate and then invest it in a currency with high interest rate. So, Japan, in terms of volume, they have huge carry trade in the sense that, people borrow money from Japan and then make investment on the U.S. asset or any other asset that yield higher interest rate. So, for example, Japan is the largest country of holding the U.S. government bond outside of the United States. So the recent movement of the Bank of Japan, if they will increase the interest rate gradually, maybe Japanese people, instead of seeking, investment, opportunity outside of their country, maybe some of the money will, go back to Japan to seek any other opportunity in domestically. So I think the money will move from the other country to Japan.
Definitely. All right, Professor Hur, thank you so much for your insight. As always, you have a great day.
You too. Thanks.